Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. After a little hiatus from the podcast, I've actually been battling a cold respiratory issue, and really it wasn't anything that affected the way I felt or my things that I did on a daily basis, but it definitely affected my voice, and it's still not back to normal. I still have a deeper than normal voice. And ladies, I know it sounds pretty sexy, but it's not my real voice. But anyways, I'm back. I apologize for not doing a podcast previous to this in the last couple of weeks. A lot has gone on in the last couple of weeks, and we start off here on this shortened trading holiday weekend with news yesterday evening that the Super Committee was probably not going to reach a deal. This idea, if you recall, going back to August, this committee was put together, 6 Republicans, 6 Democrats, to come together and to come up with a solution that all their counterparts, their Congress couldn't come up with this deal back in August, so they put this smaller committee together, figuring maybe 12 people could do it. And, with elections around the corner and these people worried about their careers, not about the country, no shock that it didn't get done, but apparently the market hadn't really priced that in. Down it went. So we have more European stuff, we'll call it. We have the Super Committee failing to get a deal done. And as you can see, the Dow Jones was down 250 points. It was down a little over 300 at one point today, so it did bounce back after there was a rumor that potentially a deal would get done, or at least talks were moving forward. Not that a deal would get done, but talks were moving forward. Maybe there was some hope that something would get done. So it bounced, but regardless, we had the Dow Jones down 248 points. We had the transports were down over 2%. Everything across the board down a couple percent. As you can see, the financials down 2.5%. And Russell 2000 was down 2.5%. Oil services, 2.6%. I was actually stopped out on my energy holdings today and sold those. So, having to put some stops in right here, because this is starting to feel like August. Now, at the beginning of this month, of course, we had the S&P had broken out of this range, this box that we had been in really since early August, and it went up, and then, of course, we kind of struggled around the 200-day moving average, as you can see on the S&P 500. But this wedge was forming, and I actually thought potentially it could break out to the upside, because, A, we have seasonally positive issues going on where we could have a Santa Claus rally, and we had already gone up. And so we had gone up, consolidated a bit, and I thought maybe we would head on up to the end of the year. Really didn't buy a bunch of things going into there were some trades I did, but for the most part, didn't really do anything. And this wedge broke on Thursday, kind of a flat down Friday, and then we come back today and we broke the 50-day moving average on the S&P 500, and it wasn't. You could argue it was light volume, but the volume was actually kind of what it was last week. So even though it was a holiday week this week, you still got reasonably good volume given what we've been getting lately. But we definitely broke down, and you could say we're back in this box. But regardless, the wedge pattern that we saw here broke down, and usually these things do break down about 3/4 of the way through the wedge if they're going to break out one way or the other, and it definitely broke down. And so the 200-day moving average kind of failed, and now the 50-day moving average has failed as well. Now you can see I've added the MACD in there. It's obviously been rolling over, crossed over right about first week of November, and it's starting to head down. So you've got that going on, and again, a lot of the stuff is, everybody sees it nowadays because there's so many technical indicators that are free to people and really charting devices and so forth. You can get them on your smartphones, your iPads. So everybody sees this. And what we're seeing now is MACD, which is one thing that I look at, but a lot of people kind of have their favorites. MACD is a very popular one. And it rolled over, and a lot of people see that. So that's happening. You got this wedge broke. You got the 50-day moving average breaking down. You get more fundamental bad news coming out. I think more importantly is the internals of the market are weakening, and they had been weakening to some extent. So the rally that we had in October had some good characteristics to it. We had the intraday reversal. We had larger than expected volume the first few days, but then that rally kind of petered out. And in fact, we had some sell-offs late in the month, and they were on pretty heavy volume, again, relatively speaking. So that kind of made people believe this thing went too far too fast, and then here we are pulling back now. So the question is, where do we go from here? Now here's a picture of 2007, 2008 on the S&P 500. It's the weekly picture, and the reason I'm showing you this is within this horrible bear market. Remember, the S&P was about 1550, went all the way down to 650. There were rallies in here of 14%, 19%, and even a 27% rally during the middle of the year. So these rallies aren't uncommon in bear markets. So if you're somebody that believes that we're in a bear market, don't be discouraged by the fact that we are having rallies that, and we just came through a rally in October that was 10+%. If you are a bull and you're saying, hey, look at the market, it's holding up pretty well given all the negative stuff going on, remember that markets tend to roll over. They don't go straight down. So these initial sell-offs, and you can see it even back in 07, there's a very brutal sell-off in the summer of 07, only to go up to new highs in the fall. That was the key, was we were going to new highs. Nobody believed that the market was rolling over. The economy was getting weak, like today. The internals were getting weak, like today. And lo and behold, we went down, broke some moving averages, held on, and then eventually broke down again. So, and I'm not suggesting that we will go down to 650 on the S&P 500, but I am suggesting that the odds of the market going down over the next few weeks and months are fairly high because the internals are breaking down, because the technicals are breaking down, and because the fundamental picture is getting worse, not better. So be careful when you look back and say, well, the stock market had a pretty powerful rally in October. You see it's already given up a big chunk of it, I think maybe half of it here in the month of November. Bear market rallies are sometimes the most violent. Again, a 14% rally, a 19% rally, and even a 27% rally in 2008. And in the 2000 through 2002 time frame, there was even four rallies of 20% or more during the 2000 through 2003 bear market. So keep that in mind when you are analyzing the market, and don't discount the fact that just because it's gone up a little bit, it can't go down further. Now I want to point something out. I had developed something several years ago where I instead of monitoring the volatility index, the VIX, alone, which a lot of people do, and they look for levels. If it's in the 40s, it's really high. If it's in the 20s, it's getting lower. If it's in the teens, it's much lower. And they try to determine which direction the stock market's going to go. I was more interested in how fast the VIX was going up. And in other words, if your house has a small leak and there's water going all over the house, but it's happening at a pretty slow pace, you wouldn't be as frantic as if you saw a tidal wave coming or a hurricane on the map. And if you were rushing to go get flood insurance, I want to see how fast the premiums are rising, right? Because if everybody wants flood insurance right when the hurricane's about to hit, insurance rates are going to go up at a very fast rate. So it's not the absolute level of the insurance rates. I want to see how fast they're going up, and it's the same thing with the stock market. If I see the VIX rising at a very fast rate, that tells me that there is panic in the streets. Now, you can see here a picture that, and the green is the S&P 500. The red is the VIX, but it's an indicator on the VIX. It's kind of massaged. It's a proprietary way that I look at it to show me how fast it's going up. And as you can see, when it gets into these lofty, lofty levels, we tend to have a bottom. It doesn't necessarily tell you it's the bottom, but a bottom. And it happened in March when the Asian situation happened. And, of course, it happened again in early August with the debt situation. So we had the spike here. We had the spike here. But look what's happening right now. We're still at this very low level, and a lot of people believe that's a positive sign, and it very well may be. But if you're looking for an easy entry point, the easy entry point is once the thing spikes up and then starts to come down. That's your entry point. And right now we're not getting that. We're not getting the spike in fear. So again, I think looking at the VIX is one way to determine how much fear there is in the market. And right now there's not a lot of fear. So if you think that's a positive, fine. But I would rather see a spike up to give me an entry point, because I think what this points out to me is that there's a lot of complacency right now. And that complacency gets overtaken by fear if the market continues to fall. So when it falls 250 points and you don't see a big move in the indicator that I'm watching, it's a little concerning for me. So we'd like to see that spike up, because, again, if we're out of the way and we see the fear spike up, then we can use our dollars and take advantage of, even if it's a temporary pop. I mean, the S&P went from 1125 to over 12, maybe 1215, 1220 once this initial spike in August took place. But this stock market right now is starting to remind me of August. You got the Europe situation, you got the debt committee debacle, and the market is starting to accelerate its move to the downside. I will tell you, we've had two 90% down days out of the last 3 trading days. And, usually when you get that, you're going to get some type of bounce. And if that bounce doesn't have any oomph to it, then we will go lower. And so for right now, there's some things I got stopped out on. But for the most part, I've been very heavy cash really since August, not doing a whole bunch. And I'm fine that way right now because of the situation that we have in front of us, which was a high-risk time. Doesn't mean you can't make money in a high-risk time. But if you're going to invest, you want to obviously invest during the low-risk times, generally speaking. And that doesn't matter if you're 30 years old or 80 years old, because I've met plenty of people over the years who claim to be risky, and then when the markets start to go haywire, the risk level comes way down. So what we want to see right now is the risks subside, or a big spike up in fear, even if the risks are high, because we get such a high level of fear and panic that it's an easy trading opportunity. And we don't have that just yet. I feel like we're kind of in the middle. Now, we have given back about half of the gains, so we may be at a spot where it could bounce a little bit. But keep your eye, unless you're wanting to trade on a daily basis, keep your eye on the medium-term picture, which is deteriorating, not getting better. And so the odds favor more downside over the next few weeks and months. And again, if we preserve our capital, and the dollar's going up right now temporarily, we will have more dollars to go put to work once this does settle out. So I kind of feel like we're in the middle right now, so just be careful. I am going to end the podcast because my voice is about to go out once again. Have a wonderful day. We will talk to you soon. Don't forget to look me up on carleggers.com, Google Plus. I'm plus Carl Eggers on there. EggersCapital.com for the money management website, and of course Twitter.com/Carl Eggers. Have a wonderful day, and we'll talk to you soon.